I bet you didn't know you could buy real estate inside of an HSA account. I'm going to talk about the savvy way of utilizing an HSA account, and then I'll get into the details at the end where you could just Google yourself if you wanted to see it, but I'll show you at the end. So like this video, definitely save it for later because you're going to want to watch this thing through the end. And as always, follow for great hacks and insight that I've gotten over almost a 20-year career in financial services. So I hope you're enjoying it. Let's get into it. So a health savings account. People hear about it all the time, right? But nobody really tells you the great benefits of it. It is an account that has triple tax treatment, okay? It's one of the only accounts that have this that you have access to get. And what triple tax treatment means is you get a tax deduction when you fund it in the current year. You get tax deferred growth wherever it's at inside the account. And then when you distribute it for qualified medical expenses in the future, you get tax-free distribution. So it has that triple tax treatment, which is amazing because not many accounts have that triple tax treatment. But let's get back to what people typically know about it, right? If you have a high tax deductible plan inside of your employer benefits, you're eligible to get an HSA account. And people just kind of leave it at face value and don't really understand it, right? And you'll have your HR person say, oh yeah, we have one, right? So here's where the savviness comes in. You don't have to use your employee-sponsored plan. If you elect the high tax deductible health plan, which allows you to use pre-tax money to pay for your deductible and whatnot, right? It has a higher deductible limit, but you get to use pre-tax money instead of post-tax money for your deductibles and prescriptions and co-pays and all that, right? So you're using pre-tax money. I'm a big fan of utilizing pre-tax money. But once you enroll in the high tax deductible plan, you're eligible for that HSA contribution. Now, the savvy way of doing it is you could enroll in the employer one, but here's the thing. You can leave, a lot of people unfortunately leave it in cash, which you're eligible to put in mutual funds in your account. But most mutual fund inside HSAs through employers, whoever the record keeper is, that's the company you log into the account on, it'll buy in bulk mutual funds every, say, $2,000. Some of them are $1,500. I've seen one time maybe at $1,000. But what that means is if you're putting money per paycheck in to the account, it doesn't buy the mutual fund until you hit $2,000 worth of money in there, and then it purchases the mutual fund. So you're not really dollar cost averaging the account because it takes a while to get to the $2,000 or $1,500 or whatever it is that buys that mutual fund. And that's something's better than nothing. If you don't want to be diligent and do the thing that I like to do personally, then you're better off just using that, right? Because something's better than nothing. But if you're diligent, what you want to do is open up a self-directed HSA. So you decline the employer contributions when you do your benefits and say you want to put zero per paycheck in. Okay, when you put zero per paycheck in, you automatically are not going to be having to go into that account. And then you open one with a different record keeper. I personally use Fidelity because I have all my accounts there. It's super easy. I like it. And when you open up the HSA through there, you then not only can buy mutual funds, but it acts kind of just like an IRA. You could buy stocks, you could buy mutual funds, you can buy crypto ETFs, anything available on the platform you can utilize. And so now you have a lot of growth opportunities with dividend reinvestment, individual stocks, mutual funds, ETFs, whatever you want, right? But the great thing about it is that it's not a use it or lose it account like an FSA. Okay, you can roll the money over year after year after year, and it just continues to accumulate. So the savvy thing is you take the deduction, you pay for medical expenses out of pocket if you can afford it to reach your deductible. You let the money sit in there and grow and grow and grow and grow and grow. And there's thousands of things literally you could use HSAs for suntan lotion, right? For massages, for gym memberships, for insurance premiums, long-term care premiums, right? There's tons of things you could use it for. But when you start this, especially the younger you are, you can grow and build up money just like an IRA. And all that money accumulates. And then down the road, you could use it for qualified medical expenses. Here's some of the things that I opened with, right? People don't know this, but you could actually invest in real estate with your HSA. It can't be a primary residence, but it could be an investment property, an Airbnb, something like this, right? A nice, beautiful cabin in, I don't know, Aspen, right? Wherever you want. Park City. You can invest in that and use it as a rental, as an investment property. So you got pre-tax, you got a tax deduction with the money going in, you got tax deferred growth into mutual funds, ETFs, individual stocks, whatever it is. And then you can pull the money out tax-free, or you leave it in what's called a self-directed HSA, and you can find a custodian and purchase real estate as an investment. Now, what's cool about this is that if you use it as a short-term rental, like an Airbnb, you can do things called cost segregation studies, which I'll do a video on later, and it allows you to use offset W-2 income through this active investment property through like a short-term rental like Airbnb or VRBO or whatnot. So let me get into now some of the stuff you can find on Google that shows you how much and how the restrictions work. As always, my content is specifically catered to millennials. If you're 55 and older, you can add an additional $1,000. But for 2025, the HSA contribution limits are $4,300 for if you file single, and $8,550 for if you're married, filed jointly. So you get that, say $8,550, you get that tax deduction, gross tax deferred, and then when you need the money in the future to reimburse for qualified medical expenses, and all you need to do is Google HSA qualified medical expenses, and you'll see that you could reimburse yourself. But again, you want to let that money grow, because it's hard to get tax-free money into an account, let alone tax-free money that grows tax deferred that you got a tax deduction on. So you want to push that off as long as possible. And all you do is save all your receipts for anything medical related, even suntan lotion, because down the road, if they want to say, hey, why'd you reimburse yourself? You could have 20, 30 years of receipts for medical expenses. And so that would satisfy the withdrawal, because it's not a use it or lose it account. So that's the contribution limits. Now, this is just the eligibility where what I talked about, where you have to be enrolled in a high deductible health plan through your employer benefits. You cannot be in Medicare. And somebody else cannot claim you as a dependent on their tax, right? So that's just the eligibility to be able to get an HSA account. You put your pre-tax money in, okay? It lowers your taxable income. The money in the HSA grows tax-free, and then you can withdraw it later at a tax-free reimbursement for qualified medical expenses. And even here, right here, unused funds roll over from year to year. So you own the account, you control it, even if you switch from job to job. And that's why I like the declining the employer benefit one, the account where the money goes into per payroll, and just doing it on your own. So you can truly dollar cost average or throw a lump sum of money in, and you get to have more options when it comes to where the money is going to be sitting and invested in the account. Now, here's the fun part, okay? Because a lot of millennials and Gen Zs want a ski cabin, a vacation home, an investment property. And this is really, really interesting, because I just want everybody to Google, can I use an HSA to buy real estate? And you'll see it pop up, right? But here's how it works. You'll need the self-directed HSA, like I said, which allows you to do alternative investments beyond typical stocks, bonds, mutual funds offered in standard HSA custodians. And then you'll find a custodian that you'll need to specialize in holding alternative assets like real estate, tax advantage accounts. And again, this isn't hard to do. It's quite simple. A quick Google search, you could find these people. And when you do finally, and if you decide you want to buy an investment property with your HSA money, it has to be an investment. It's not for personal use. So it has, you can't live in it, right? It could be a rental property. You can't live in it personally, but this is perfect for people who want to have an investment, especially an active investment property like a short-term rental, where you could utilize other tax deduction strategies like cost segregation studies through accelerate depreciation, offset W-2 income. This is great for, like, say, firefighters, police officers, anybody who has a W-2 income that has the ability to work a lot of overtime and make money. You don't have really that much deductions when you're W-2, but you can go ahead and use investment properties. And this is just another way to help you get more of what you want in a more tax-friendly way. As always, follow for more great content. Really enjoy doing these videos, trying to change the game, bring some insight to people, and start telling you where to look at, right? This isn't advice. I'm not telling you to do it. I don't know your situation, but this is what I do. And the HSA is one of the best accounts you're ever going to come across because of the options you have. Even if you don't want to buy real estate, having that tax deduction, tax for growth, money that you don't use, that it gets to roll over an account that can grow for decades, that is so valuable. I hope you enjoyed the content.